Right friends, welcome back to Banking Awareness. This is 7th module, a snapshot on banking operations. We are discussing in detail the banking operations, and in this module we are going to discuss standing instruction, what is meant by standing instruction, debit cards and credit cards, what is the difference between debit cards and credit cards, NPCI, what is NPCI and what is its role, then what is meant by Negotiable Instrument Act of 1881, and what is the difference between bill of exchange and a promissory note. So, these issues we are going to discuss in this lecture, and the first one is standing instruction. What is meant by standing instruction? I will tell you two examples. You have taken house loan, and you are required to pay monthly installments, and all of you are well aware that the installments which we pay are known as EMIs. We pay EMIs on house loans. Similarly, for your child, you may be required to pay school fee regularly, right? School fee regularly or insurance premium regularly. Then EMI of house loans or personal loans, regularly we may be required to pay. So, for regular payments, instead of giving checks, we give standing instruction to the bank. I have bank account with the State Bank of India. I am required to pay these type of payments every month regularly to various organizations. Under such circumstances, what I will do is, I will instruct my bank to pay these payments regularly. That is known as standing instruction. Otherwise, sometimes it is known as mandate also. So, mandate or standing instruction is the instruction given by the account holder to his bank to pay regularly to the third party, right? So, this is about the standing instruction. Remaining things are available in the PPT. Let us look at debit cards and credit cards. These are plastic cards. Nowadays, plastic payments or electronic payments are the predominant type of payments. Previously, cash used to be the predominant mode of payment, but nowadays these plastic payments are almost into hook and nook of the country. They have reached even remote areas like villages. Especially debit cards reached into the interiors of the country, and credit cards are yet to have penetration into rural areas. So, what exactly debit card and credit card? These are nothing but plastic cards that work on some financial platform. They work on some financial platform. All of you are well aware about financial platforms of Visa or MasterCard. All of you are well aware about financial platforms of Visa, MasterCard. China has got its own financial platform, Union Pay, and American Express, Discover. There are other types of financial platforms, and India also developed its own financial platform, that is RuPay platform. Previously, we used to take the platform of either Visa or MasterCard, but we developed our own platform RuPay, and we are going to discuss in detail, right? So, what is debit card and credit card? Debit cards and credit cards are instruments to facilitate financial transactions without the need for carrying cash. Please remember, without the need for carrying cash, these plastic cards can be used for purchasing something and for doing several types of financial transactions. But you may ask, what is the main difference between debit card and credit card? Let us look at debit cards. Whenever you open bank account, banks will give you ATM cum debit card. That means the card can be used not only at ATMs, but also at various merchant outlets, that means POS terminals. When you go to some shop or when you go to some shopping mall like a Shopper Stop or lifestyle store, immediately you can see one POS terminal. You can swipe your card and make the payment. So, this ATM cum debit cards can be used not only at ATMs but also at various merchant outlets, that is POS terminals. Third important thing is for online transactions also you can use your debit card, and debit card means spending your own money. If you have balance in your account, then only you can use the debit card. So, it is spending your own money, and whenever you spend, it will be reflected in your account instantaneously. Whenever you spend some money, it will be reflected in your account instantaneously, and debit card transaction is connected to your bank account, and control over expenditure will be there because it is your money. You normally spend money by using normal prudence. That is why control over expenditure will be there. But look at credit cards. Credit card is nothing but it is spending bank's money. When ICICI Bank gives you credit card, ICICI Bank will give access to their money up to some extent. If the limit on credit card is rupees 50,000, the point to be noted here is you are allowed to spend up to rupees 50,000 of ICICI money, not your money. In credit card, you will access the funds of bank, right? When you are accessing the funds of the banks, it is nothing but loan. And please don't forget, the transaction under credit card is classified as revolving credit. What is the meaning of revolving credit? Revolving credit is you purchase something this month, again pay back to the bank, again purchase something, again pay back to the bank. That means you are purchasing, paying back to the bank, purchasing, paying back to the bank. That means you are accessing bank's funds and time and again you are paying back to the bank. So, that is the revolving credit, right. So, credit card transaction is categorized as a revolving credit. It is accessing bank's funds and monthly bills will be generated. You will be given grace period. You have to pay back within the grace period. If you are not able to pay back within the grace period, you have to pay heavy interest, maybe around 36%, right. That is most important. And as you are accessing bank's funds, that means you are taking loan initially, that may lead to frivolous spending. That means you may spend like a careless man. Debit card transaction, you may spend like a careful person or prudent person, but while undertaking credit card transactions, normally frivolent expenditure may be there. But don't forget, credit cards are used in emergencies. The advantage of having credit card is in emergencies you can have access to bank's money, but disadvantage is if you are not able to pay back within the grace period, you will be fined quite heavy interest. Second disadvantage is it may lead to frivolous spending, right. So, this is the basic difference between debit card and credit card. Credit card is useful for emergencies. Right friends, look at this Visa and MasterCard. All of you are well aware about Visa and Master platforms. For the past several years, we are seeing Visa and MasterCard only, but recently another platform of India, that is the RuPay platform, was devised, right. This Visa and MasterCard, these are American based companies and these are headquartered at New York and California, and as we are using their platforms, we have to pay a lot of foreign exchange to them, and our own indigenously developed platform RuPay is available at present, and Union Pay is the platform of China, please don't forget. Visa and MasterCard, these two are the platforms of United States of America, right. And let us look at RuPay card. Before going into RuPay platform, who devised this RuPay platform? This RuPay platform is devised by National Payments Corporation of India. National Payments Corporation of India is the organization which is in the forefront for developing various mechanisms for retail payments across the country, and National Payments Corporation of India was established in the year 2008 and started functioning from 2009, and it was started by 10 core promoter banks, not by RBI. NPCI was not established by RBI, it was established by 10 core promoter banks with authorized capital of 300 crores and paid up capital of 100 crores. At present, there are 10 core promoter banks who promoted this National Payments Corporation of India, and headquarters is in Mumbai. What is the role of NPCI? NPCI is consolidating and integrating multiple payment systems in the country, right? And developing uniform and standard processes which will ultimately benefit common man. What are the products developed by NPCI? Please look into this. National Financial Switch. You may ask, what is the National Financial Switch? National Financial Switch is, if you are the customer of ICICI Bank, if you are accessing ATM of Punjab and Sindh Bank, that is made possible because of interoperability developed by NPCI under National Financial Switch. So, National Financial Switch facilitates operation of one customer to other bank ATM. That means customer of one bank can have access to ATM of other bank. That is made possible because of National Financial Switch. You may ask, what is automated clearing house? Automated clearing house is transactions which will be undertaken on mass scale. All of you are well aware, government is giving old age pensions. There may be 1 crore people in the country who are receiving old age pensions. Government need not send each and every account by clicking each and every account. That is made possible for bulk transactions on mass scale is made possible. That means by triggering a button, by triggering a click, lakhs of transactions can take place at a time. That is made possible through automated clearing house. Third one is immediate payment service or IMPS. IMPS is the platform for transferring money through mobile phones. When you are transferring money, mobile money identifier or 7-digit MMID will be given. Based on that MMID, you can transfer money. That is IMPS. Next is check truncation system. If you are issuing check in Chennai and your friend is depositing in Delhi, previously that check used to be transported from Delhi to Chennai for verification, but now no more required. Only digital image will be sent. This is also developed by NPCI. The fifth one is Aadhaar Payment Bridge System or APBS. That means Aadhaar linked payments. Gas subsidy. By linking your Aadhaar number, you are getting gas subsidy into your bank account. That is also made possible by NPCI. Last one is RuPay card. RuPay card we have already discussed. It is the equivalent of Visa and MasterCard. And let us look at RuPay. RuPay is indigenously developed by NPCI. Just now we have discussed. And RuPay means rupee payments. RuPay means rupee payments. And it consists of orange and green arrows. On the RuPay card, you see the logo which is having two colors, orange and green, and it was launched in 2012, but because of various reasons, it was not successful initially. Now under Pradhan Mantri Jan Dhan Yojana, government has given around 13 to 14 crore RuPay cards recently. Right friends, after discussing about what are various types of debit cards, credit cards, what is NPCI, and next aspect is RuPay card. Let us look at Negotiable Instruments Act. What is Negotiable Instrument Act? It is the old act enacted in 1881 during the British rule, and subsequently several amendments took place, and negotiable instruments are the instruments used for making payments. Negotiable instruments are the instruments used for making payments, and they are enforceable in a court of law. Negotiable instruments are the instruments which are used for making payments either in personal capacity or in business. Either in business or in personal capacity, these instruments can be enforceable, right? So, this Negotiable Instrument Act pertains to 1881, right? And as per Negotiable Instruments Act, it constitutes three types of instruments. One is the bill of exchange, second one is promissory note, and the third one is check. These three are mentioned in the Negotiable Instrument Act, that is bill of exchange, promissory note as well as check. But demand draft is not mentioned, but bill of exchange properties and demand draft properties are almost similar, right friends? And look into this currency note. This 100 rupee currency note, please go through what is written. It is written as, I promise to pay the bearer the sum of 100 rupees. That means whoever holds this currency note, he will get any goods worth rupees 100 value, right? This is called a bearer instrument. If the currency note is with me, I am the owner. If this currency note is with you, you are the owner. That's why these are called bearer instruments. Bearer instruments are the instruments anyone can get their value and no name is mentioned. They are not person based. They are just, the owners will be the persons whoever holds those bearer instruments. They are not given by name. But when you look at order instruments are specific by name. Why I am explaining these two things is, in the negotiable instruments, you will come across these two terms, bearer instrument and order instrument. Please don't forget, this currency note is example of bearer instrument. If this currency note is with me, I am the owner. If this currency note is with you, you are the owner. But order instrument is not like that. Order instrument is specifically in the name of a person or business entity. Right friends? So, look at the issue. What are the specific features of Negotiable Instrument Act? These are written documents. These are transferable from one person to another person. Merely by delivery in case of bearer instrument. This currency note is example. If I give this currency note to you, merely by delivery it is transferred. But in the case of order instruments, it is transferred with endorsement. Order instruments are transferred by endorsement. Bearer instruments are transferred just by delivery. And the owner is the bona fide owner for value. The owner is bona fide owner for value. That means if anyone is having this instrument, he is entitled to that much of value, right? So, these are the features of negotiable instruments. Let us look at bill of exchange. Bill of exchange was mentioned in the Negotiable Instrument Act 1881, but the features I would like to explain you by taking demand draft. Let us first look at the nomenclature of this bill of exchange. It is a written unconditional order by the drawer to the drawee to pay money or to the order of the payee. And to explain this, I will take one example. Please look into this. You are staying in Delhi and your bank is State Bank of India, Delhi. You are staying in Delhi, your bank is State Bank of India, Delhi, and you got admission to IIT Chennai. You got admission in IIT Chennai. You are required to pay a fee of rupees 1 lakh. You are required to pay a fee of rupees 1 lakh. Then you will take demand draft and your bank in Delhi will issue demand draft. Your bank in Delhi will issue you demand draft asking SBI Chennai to pay to IIT Chennai rupees 1 lakh. You have to pay rupees 1 lakh fee. Your bank in Delhi will issue you demand draft asking State Bank of India Chennai to pay to IIT Chennai. Right? So, you will get demand draft from State Bank of India, Delhi. So, here State Bank of India, Delhi is drawer, State Bank of India, Chennai is the drawee and IIT Chennai is payee. That means State Bank of India, Delhi is ordering State Bank of India, Chennai to pay to IIT Chennai. So, this is the feature of bill of exchange. This is the feature of bill of exchange. If you look at the definition, you will be clear. It is the unconditional order by the drawer. Drawer in this case is State Bank of India Delhi to the drawee. Drawee here is State Bank of India Chennai. To pay money to the payee. Payee is IIT Chennai. So, bill of exchange you can interpret now as a demand draft, and in the Negotiable Instrument Act, bill of exchange was mentioned, demand draft was not mentioned, but the features of demand draft are more akin to bill of exchange. So, please look into the features of bill of exchange. It must be in writing and duly signed by the drawer. That means State Bank of India manager Delhi should sign it. It should contain an order to pay. It will mention something 1 lakh rupees to be paid. The order or instruction must be unconditional, no conditions. Whenever any demand draft is issued, it is unconditional, no conditions are accepted, and the amount must be certain. So, these are the features of bill of exchange. I hope that this example is clear to you. So, bill of exchange, or you can say demand draft, is the unconditional order by one entity, that means by the drawer to drawee to pay to the payee. In this case, State Bank of India Delhi instructing State Bank of India Chennai to pay to IIT Chennai. So, these are the features of bill of exchange. I have taken this banks as an example to explain your demand draft, and the features of bill of exchange are almost similar. After learning about bill of exchange, let us look at the second instrument under Negotiable Instrument Act, that is promissory note. And to explain promissory note, I have taken one example between X and Y. X is the creditor, Y is the debtor. You should have clear differentiation between creditor and debtor. X gave some money to Y, that means Y borrowed money from X. Y borrowed money from X. In this case, X is creditor, Y is debtor. Y borrowed money. The person who ever borrowed is the debtor. The person who ever gave money, he is the creditor. In this case, X is creditor, Y is debtor. X gave rupees 1 lakh to Y. In return, Y will give promissory note to X. Y will give promissory note to X. Right? So, this is simple to understand, this illustration. So, promissory note is unconditional commitment. In this case, unconditional commitment made by Y in writing and signed by the debtor, in this case signed by Y, to make payment to a specified person, that is X, or to the order within a specified period. That means Y borrowed money from X, and in return Y has written promissory note to X. This is about promissory note, right? This is second type of instrument, promissory note. The first one is bill of exchange, demand draft, please don't forget. And here this is promissory note. I would like to explain you once again. Y borrowed money from X. X is creditor, Y is debtor. In this connection, I would like to tell you, if you deposited 1 lakh rupees in State Bank of India, if you deposited 1 lakh rupees in State Bank of India, you are creditor, State Bank of India is debtor. And at the same time, if you have taken loan from State Bank of India, if you have taken 1 lakh rupee loan from State Bank of India, State Bank of India is creditor, you are debtor. That means borrower is debtor. The person who gives money is creditor, and promissory note is written by debtor and it will be given to the creditor, right? I hope you are clear about this promissory note. And difference between promissory note and bill of exchange: promissory note is unconditional promise to pay. That means debtor will give unconditional promise to pay back to the creditor. And what is bill of exchange? This is unconditional order to pay. As I have discussed previously, this is the unconditional order given by SBI Delhi to SBI Chennai to pay to IIT Chennai. IIT Chennai is payee. State Bank of India Chennai is drawee, and State Bank of India Delhi is drawer, and two parties are involved in promissory note, only creditor and debtor. 2 parties are involved in promissory note, but 3 parties are involved in bill of exchange, or I can tell you in demand draft. And promissory note is drawn by the debtor, right? And bill of exchange is drawn by the maker, creditor or drawer, whatever you call it. Here in this case, State Bank of India, Delhi is the drawer and they sign the demand draft. So with this, we will conclude this module, which involves standing instruction, debit cards and credit cards, NPCI, Negotiable Instrument Act 1881, Bill of Exchange and Promissory Note. Please do join for 8th module. We are going to discuss with regard to checks. Right friends? Thank you.